And welcome to my daily chorus for Thursday, August the 7th. I'm Bernard Hickey for the Kaka. Every day I try to understand what's going on in Aotearoa's political economy around housing, our massive housing shortage and affordability crisis, climate, what we're doing to reduce our emissions and prepare for climate change, and poverty. How the combination of those two things, our unaffordable housing, along with our high costs of living, plus the dangers we face from climate change, are worsening our already awful poverty situation. So today I wanted to focus on a couple of big things that have come out. Firstly, the June quarter labour force figures, which tell us quite a bit about how many people are working in Aotearoa, what their wages are, how long they're working, how many hours they're working. And it really is the proof in the pudding for claims by many about the economy. If you've got a healthy economy, jobs are increasing, and so are wages. And typically they're rising faster than prices. Now, one of the reasons for unhappiness about the cost of living, particularly through 2022 and 2023, ahead of the election, which Labor lost, was that wage inflation was slower than price inflation, particularly food, energy, and housing. And that was a contributor to the loss of the government. Well, the current government, the new government, said they were going to get on top of inflation and that they were going to get growth going to improve jobs and incomes. However, after a bit of a bounce in the March quarter, we've seen in the June quarter the economy sink back into a hole. And that's because our housing market is stalled. Construction has dropped sharply. There's been 16,000 job losses. The government froze spending on new house building, on uh, school building, and on hospital planning at the beginning of 2024. And this has shocked the construction and infrastructure sector and has led, on top of the already slow retail spending situation, to another downturn. And currently, the Reserve Bank of New Zealand is forecasting that GDP has actually fallen 0.3% in the June quarter. So these jobs figures for the June quarter are very important. Markets, so economists, the consensus economist forecast was for a rise in the unemployment rate from 5.1% to 5.3%. And that was actually more than what the Reserve Bank had been expecting, although that Reserve Bank forecast is a bit old now. And in the end, what we got was a rise from 5.1% to 5.2%. So that sounds good, doesn't it? The trouble is that was flattered by a drop in the participation rate and a drop in the number of people who are looking for work. So people are giving up after failing to get a job. And so we saw an increase in unemployment in the quarter of a couple of thousand. And we saw also, more importantly, I think, a drop in the number of hours worked. So there are people who are still in work, part-time and full-time, but they're working fewer hours. Employers are reluctant to let them go completely, but they're not giving them the hours. So that's reducing people's incomes. In fact, when you look at what's happened in the last 6 quarters, so the last 18 months, there has been 8.5 million hours fewer worked in our economy because it's amazing when people don't have enough money to spend on the basics, particularly those who are renters, then shops close. When factories have to deal with record high inflation and electricity prices, which are mandated by the government, and they shut down, people lose their jobs and they don't spend money. So what we have here is a government hell-bent on reducing the deficit and getting debt down, which has delivered a shock to the economy on top of the shock from the Reserve Bank and sent the economy back into a double dip recession in the June quarter, which looks likely to continue through into the September quarter. And these jobs figures reflect that. So not only did we see 8.5 million fewer hours worked, but also we saw wage inflation drop sharply. So the labour cost index measure of wage inflation, not average weekly earnings, so labour cost index, and that is the best measure, like for like, of wages. So it takes into account people getting promotions or people who have changed their skill levels. So this is very much like for like. That is now down below CPI inflation for the first time in almost 2 years. So what we're seeing now is real wage deflation. And we got some reactions from politicians. Nicola Willis said some people were looking at this with a glass half empty. She preferred the glass half full approach. She said it was very unfortunate people had lost their jobs, but they shouldn't blame themselves. And she also said that we just needed to hang in there for a bit longer because Treasury had forecast a rebound in the housing market. Interestingly, and I include it in some charts that I've got today. Let's have a look at these charts. Um, when you have a look at our, there's the wage deflation. So you can see there, end of 2021 through the beginning of 2023, we saw wage deflation, and that contributed to the loss of the Labor government and the so-called cost of living crisis. And then for a year or so, into 2023 to 2024, as inflation fell sharply, wages didn't quite fall as much. So that gap in there seems to show some wage inflation, real wage inflation. But now you can see with the lines have just crossed again, Ghostbusters style, and that's bad news for workers. And when you look too at what's happened to the employment rate, so the percentage of the population who are actually working, some of which are looking for work but unemployed, some of which have given up on looking for work and they're still not working. You can see there that compared to the Reserve Bank's forecast for the last 2 years, it's been consistently worse. And this chart tells us that the Reserve Bank held interest rates too high for too long, and they've done it again at the last decision. They won't make that mistake later on this month. August the 20th is their next decision. Everyone expects them to cut another 25 basis points from 3.25 to 3%. And most economists at least expect cuts towards 2.5% as the so-called neutral rate. The trouble is when you've got an economy in recession and the Reserve Bank is supposed to avoid inflation falling below its target band. So if you have lots of unemployment, there's lots of spare capacity in the economy, wages tend to drop, prices drop, and you get yourself into a spiral. And the risk is that inflation's too low. Then that's when the Reserve Bank should be running stimulative policy. And at the moment, it's still running contractionary policy. 3.25% is right at the top of their sort of neutral target band, 2.5 to 3.5%. So they need to get that below 2.5% if they're going to make a lot of progress. Again, shows up the flaws in our monetary policy system where the way to solve inflation is to make people unemployed, which is just awful. Right. But remember, the jobs number was up 0.1% when the Reserve Bank had expected. The jobs number, so the jobs employment number, the extra number of people in work, that actually fell. So there were fewer people in work when the Reserve Bank had expected a rise of 0.2%. Right. This is also, for what it's worth, the highest unemployment rate since September 2020. So really since the COVID era, and well above what we saw before that. To give you an idea, it's not just me who's saying that the headline number flattered the economy. Both the falls in numbers of hours worked and the pay in the last quarter showed a much faster pace of contraction than overall employment and filled jobs, suggesting firms continue to cling to workers in the face of weak demand, i.e. there is still job hoarding going on, and therefore a risk that when those employers give up on the recovery that's supposed to happen, that you see a lot more unemployment. So, Nicola Willis, there we go. Glass half full, glass half empty. She's glass half full. She's still blaming Labor. We inherited the awful human aftershock of poor economic management, she says. Now, the other big event was the release of the Commerce Commission's grocery report yesterday. Every year it produces a report on how the grocery sector has gone in terms of prices, inflation, profitability, because of course the concern of many customers, let alone the regulator and the government, is that we have a duopoly, Foodstuffs versus Woolworths, that has meant that our food prices have been higher than they otherwise should have been if we'd had a competitive market, and they're certainly higher than overseas, and has contributed to the cost of living crisis. Now, one way you can measure competition in the market is the so-called Herfindahl-Hirschman index, the HHI index, for those who love a good nerd out as in economics. And the score in 2024 was 3,601, so basically the same as 2023. And remember, a low number is a good number in terms of if you've got a low number, you're a competitive market. Well, Great Britain has a very competitive grocery market. Their number is like 1,500, so well less than half ours, and shows that our market hasn't gotten much more competitive in the last year. Now, overall, so both Woolworths and Foodstuffs, remember Foodstuffs is Pack and Save and New World, overall there was a very slight improvement in margins, so slightly lower margins for the whole industry, but that disguised some increased profit margins for Foodstuffs, particularly in the South Island. And overall, Foodstuffs, North Island and South Island, they're two separate beings in theory. In fact, they tried to merge, but the Commerce Commission said no. Foodstuffs are really monstering Woolworths at the moment. They're winning market share, and Woolworths is actually barely making a profit. They really got hammered in the last couple of years by Foodstuffs. So just to give you a sense of, what happened through COVID and in 2021, 2, 3, if you measure what um, businesses, particularly grocery retailers, paid for their inputs and what they charged for their products, so the gap is the profit margin, you can see there was some profit margin expansion through 2022 and 2023. Now, there wasn't much in 2024 overall, but again, that disguises what's happened in both the North Island and the South Island, particularly Foodstuffs South Island, and both New World and Pack and Save, significant margin expansion, about 1%. Now, there was some margin detraction for Foodstuffs, New World, and Pack and Save in the North Island, but nothing like what Countdown Woolworths is seeing. So that is worth knowing. And the number I showed you before is there for non-fresh food products. For fresh products, there was also some slight margin increase. And just finally, just to give you a sense of how profitable our grocery chains are, or at least Foodstuffs ones are, in 2024, Foodstuffs North Island still got a 7% profit margin, and Foodstuffs South Island at 6%. Now, the only reason it's not the two highest in the world is Woolworths Australia is going gangbusters at 6.1. Woolworths New Zealand, 1%. And that gives you a sense of how our grocery market stacks up in the rest of the world. And the government says it's keen to do something, hasn't done anything yet. And the supermarket chains are still saying that there's nothing to see here. Well, it clearly is. And even though it didn't get much worse last year overall, if you're in the South Island and all you've got is a Pack and Save or a New World, this is some useful reading of the stats there. And there's links to those documents in my email newsletter. I'm Bernard Hickey. That was my daily chorus for Thursday, August the 7th, for subscribers, paying subscribers to the Kaka. Ka kite anō.